Yeah, my name is Thomas Reagan. I'm a professional property investor here in Australia. Me and my wife have 20x our property portfolio's equity position in the last 4 years. Now, just wanted to speak about different types of capital growth that you can get in property. Now, before we get into it, I just want to say whether you're looking for a blue chip property or a property that's in a gentrifying area, or you're looking for a property at the bottom of the market cycle, it doesn't that all that aside, you definitely need to know when you're purchasing property what the actual market value of the property is, and that doesn't mean what the property price is being what the property is being listed for. That means comparatively in the market, what are other properties that are similar to that property selling for versus the one you're buying, and if there are any differences, what are the value of the values of those differences that are within the property you are purchasing. Also, I think again, it's important to know what part of the market cycle you are in if you're purchasing a property. It's super critical, especially if you're an investor. It will change the strategy you use when it comes to negotiating a property, and that's a big one, right? You're gonna either lose or I wouldn't say lose, but you can save a lot of money in the negotiation. Sometimes it can be thousands, tens of thousands, hundreds of thousands, could even be millions of dollars if you play your cards right in there. And before you get into the negotiation, knowing the market cycle you're in, that's critical. So let's get into this. So one type of reason, or one reason why a property will get capital growth is through gentrification. Now, this might be an area that has been riddled with housing commission for a long time, or it might be an area that's been overlooked as areas urbanize and as city fringes push out, or even in a city, areas in a city where they're considered like slummy, or not as nice as other suburbs, or nice as other areas or other streets. And what actually ends up happening with these areas is because all the other areas around it run out, these or developers or investors or whoever that is buying within that area view it as it has potential, right? Say for example, in Sydney, Australia, there's a place called Campbelltown. It's about 50 k's from the CBD of Sydney. But it's house and land packages have been built around it, behind it, and so far they've built so far past it, and they've got so expensive out in these areas, which essentially just used to be farmland, that this area that is called Campbelltown, that is riddled with housing commission, has now turned into something that is being gentrified. The properties within that area were at some point very cheap, and because of that, the reason was obviously because it's housing commission everywhere and not very nice people living around, but because of the fact that they were so cheap, it created people to look at them, take another look at them again and go, hey, you know what, like that other house that's like maybe another 10 kilometers further from the CBD than Campbelltown, that's costing me another $500,000, maybe it's worth me taking a look at Campbelltown now, because it's just a lot cheaper, and I could build a house there and save a lot of money, and it's closer to the city, right? So another example, and I'll just be quick with this one, is Potts Point in Sydney, and that is in the CBD, or not in the CBD, but it's in the inner city, and the area used to be called the Golden Mile. It was filled with strip clubs, nightclubs, terrible stuff like that used to happen all the time. party, 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 drugs everywhere. And now it's a affluent area where young families like to live. There's restaurants area everywhere and all that. Now, if you knew that was coming, you obviously would have, and you're an investor, you obviously would have purchased there when everything was so cheap, because there were so many prostitutes around and drug lords and everything like that. And you would have said, look, I can see that this is a little pocket area, and every suburb, every suburb around it is so expensive. This area has potential for huge growth. And it did. It just took time. The area gentrified, all the disgusting activities got pushed out, and now it's a nice affluent area, and it matches with the rest of the areas around there. Now, blue chip areas, this is another type of capital growth you can get. Typically, blue chip areas are called blue chip because they're they're the safest bet when it comes to investing. You don't need to be a professional investor. You don't need to understand market cycles. You don't need to know anything about it. All you need to know is it's, in most cases, the growth on these blue chip assets is going to be very steadily going up at a high rate. Okay, that's what a blue chip asset is. A blue chip asset is in an area, very sought after area, very scarce area, and they're considered very sound investments. Now, the downside of obviously investing in a blue chip area, it's not like investing in an area that's about to gentrify and you're getting it for a discount and then you get huge capital growth. It's just like you get substantial capital growth consistently. You don't have to wait for in the Potts Point example, for the prostitutes to be pushed out and the drug people to be pushed out. You don't need to wait. You don't need to understand that that's going to happen. A lot of people don't understand that that's going to happen. All they need to know is this property steadily going to grow over time indefinitely, right? Not to say that blue chip markets never go down, or they never get to the point where they flatten, or they never are hard to sell, because sometimes it is hard to sell blue chip assets if the market's bad, but for the majority of the time they're pretty safe investments. And again, the downside is you have to generally, as an investor, if you're looking to invest professionally, you're generally looking for properties that support themselves in terms of cash flow, right? You want to be purchasing properties that have positive cash flow. The issue with blue chip assets is they don't. They generally, you need to supplement your investment, which we're going to call it a hobby. You need to supplement your investment hobby with your income. Now, I'm calling it a hobby because I don't consider someone that supplements their investments with other income a professional, because without that income that they're supplementing, there's no business here, because you can't have a business if it's running negative cash flows. Just FYI, if you have a business and you're losing more money than you're making, you won't be in business for long. All right. Now, I think that's about it. Yeah, and just to hit again on markets, right? So, another form of capital growth. There was gentrification. There was blue chip areas, and there is market cycles. So another one, market cycles. When it comes to market cycles, it doesn't matter if the property you're investing in has gentrification or not. It doesn't matter if the property is in a blue chip area or not. It could be the best property in the area, it could be the worst property in the area. If you understand market cycles, the entire market, if the market is going through a market cycle, the entire market is going to grow. Okay? There's going to be growth in the entire market. If you own a property in that market, whatever property that may be, there is going to be growth. So it's you're going to get capital growth through market cycles. I recommend understanding market cycles, and you can layer that into these other forms of capital growth. Mostly I just focus on market cycles because I feel like it's the easiest way to make huge returns. And cash flow positive properties and huge returns are an amazing thing. Now, another one, I just want to I'll give you an indicator for market cycles. Now, I've said it a few times, but an indicator for that a property is going to go through a market cycle is a repressed price. Okay, so for example, if you look at if you look at, say, like Melbourne to Sydney or Melbourne to Perth or whatever, and you're looking at Melbourne and you're going, like a 3-bedroom house on a 500 square meter lot that's 30k from the CBD is, say, $500,000 in Melbourne, and in Perth it's 180. That price is very low. That's like comparatively, that's very low. And I'm not saying the price in Perth should be as much as the price in Victoria, but it shouldn't be that much lower. Okay, so that's an opportunity there. And also, you could even go, okay, the prices in Melbourne are much lower than the prices in Sydney. They should be lower, you're right, but not that much lower. You shouldn't be able to, it shouldn't cost you, say, $1.3 or $1.5 million to buy a comparative property in Sydney when the price in Melbourne is 500k. So when you look at it like that, that's another opportunity for capital growth. Similar to how you would view it in gentrification and all that sort of stuff. So hopefully that's helped in giving you some clarity in how you can get some capital growth in your properties. See you next time, guys. Bye.